Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, October 23rd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So as always, we'll start with today's key macro question, which is, will the Trump trade derail the stock market? Part two. Recall that we discussed that yesterday in case you missed yesterday's macro minute. Our answers are Trump's tax and tariff policy, more specifically, the global ramifications of that via rising real interest rates, spurring higher bond market volatility and declining global liquidity, and via a stronger US dollar, curtailing China's stimulus and reducing global liquidity as well, is where we see the most risk to risk assets over the medium term from a US fiscal policy perspective. As we learned during Trump's last administration, the executive branch has tremendous leeway to set tariff policy. It may be the case that we see a global trade war as a day one policy well in advance of any tax cut proposals making their way through the congressional budget process. Moreover, reversing immigration flows would cause a negative supply shock in the labor market, slowing growth and accelerating inflation in the process. Our base case, however, remains for investors to buy any near-term correction in anticipation of the current risk-on market regime, generally persisting into at least Q2 of next year. If we are wrong on that research view, then our risk management systems, i.e. KISS for retail and Dr. Moore for institutional, will instruct 42 Macro clients to take down risk on a short lag with plenty enough time to avoid the worst of the correction or crash. Refer to our deft sidestepping of the August correction for the most recent example of the efficacy of our signals. Transitioning to our 42 Macro dashboard here, as always, we'll wrap up the question from our community. This one's regarding the dollar cost averaging. It says, hi, DD. Bringing in a large amount to my investments. That's fantastic. Good for you, my friend. Do you recommend DCA or to buy the full amount outright given the current market? Thanks for a great job. So appreciate the kind feedback. KISS has been kicking butt and taking names for a couple of years now, especially this year. Really proud of the solutions that we're delivering to our clients with respect to our KISS portfolio construction process that we maintain for our retail investors to keep them, properly invested in bull markets, and more importantly, at times, getting them to safety heading into bear markets. We obviously do that for our institutional clients as well, but our discretionary risk management overlay is a little bit more complicated, and I would argue is probably not a good solution for the average retail investor. It's a great solution for retail traders, folks who want to overtrade their portfolios and succumb to their action bias because they keep hearing stuff on Twitter and podcasts. If that's you, Mr. Retail Trader, discretionary risk management overlay is keeping the bonuses fat for many buy-side portfolio managers, so you should definitely check it out. But if you are a retail investor and you're considering how to get fully invested into our current KISS allocations, then look no further than our KISS FAQ in terms of some of the insights on that. So this is our client dashboard. Let me just go back there just to show where how to navigate that. So this little hamburger menu up here shows where all of our educational, all of the different kind of features that we have in our program. Here, 42 Macro for our clients. All the educational materials are down here at the bottom. So we have our macro class as a three-part macro class, which we help investors learn sort of three things. One, what to look for and what not to look at, more almost as importantly, when you're sort of paying attention to macro, because there's a lot of noise out there and there's not a lot of signal. Number two, what I think are the two most cycles to sort of forecast are the business cycle and the liquidity cycle. So we give you some deep insights on how to forecast those things, and then what to pay attention to there. And then we wrap up the presentation with how institutional investors use macro and or quant signals to generate consistent, actionable investment guidance. So if you haven't taken our macro class, I highly recommend it. It's free for the entire world. That's our contribution to helping the global investor community become better investors. Our KISS FAQ and our Dr. Mo FAQ are also available to clients as well. Within our KISS FAQ, we address this specific question specifically. Going back to the question was, hey, should I hurry up and buy, or should I dollar cost average to get fully invested? So I'll just take you to this entry here. It says, what if I'm a new member and need to get allocated to a fully invested or near fully invested KISS from scratch? So our answer there, and again, all these answers are coming directly from me, from my institutional experience across global Wall Street. So take it with a grain of salt if you want, but there's a tremendous amount of learning about how to invest, how to get in positions, how to get out of positions, all things that I've learned from interacting with our buy-side client base for the past 15 plus years. So reading the answer verbatim, it is always best to dollar cost average over time when allocating significant amounts of capital into asset markets. Dollar cost averaging provides investors the best opportunity to take advantage of price dislocations in asset markets to lower the cost basis of positions. Much like rebalancing, there is no right answer for dollar cost averaging, as much depends on the bandwidth of a particular investor might have to execute trades. So the strategy that 42 Macro founder and CEO Darius employs is to buy a maximum of 1,500 basis points or 15% of your portfolio of a particular position each Friday afternoon until the desired exposure is reached. For example, the strategy would put a 60% position in the SPY ETF from a starting point of 0 over a span period of 4 weeks. If the SPY ETF declined considerably on any day prior to Friday in any given week, then it is appropriate to pull forward that week's 1,500 basis point purchase to that day. So for example, let's say I have 4 weeks to get up to a 60% position in SPY. If I'm waiting on for the next consecutive 4 Fridays to do that, but if during one of the weeks there's a 2% down day on Tuesday, I'm not going to ignore the 2% down day on Tuesday. I'm going to take advantage of the 2% down day on Tuesday and skip that Friday's purchase and reset for the next week. So that's kind of what we're doing. So again, there's no need to wait for Friday if you have a significant down day to take advantage of from a price dislocation perspective earlier in the week. The reason I wait to Friday is because it gives me 5 whole days to see if there's a price dislocation. Sometimes there's not a price dislocation. Sometimes markets are in a raging bull market and they just continue to grind higher. So you got to just hold your nose and buy it on Friday and then wait for the next week to see if you get a dislocation. But again, this is not no strategy is perfect in terms of getting in and getting out of positions. Well, actually, no, I disagree. Getting out of positions, which we also answer in this FAQ as well. In our view, getting out of positions, you must do that quickly. Whenever you get a signal to take down risk, it is a fool's errand to look around and wait for the rest of the theater to exit before you decide to get up out of your seat. Generally speaking, markets crash down, they take the elevator down and the escalator up. And so you have time to wait, generally speaking, when you're dollar cost averaging into positions. You, generally speaking, do not have time to wait whenever you get a sell signal that's generated by our systematic KISS portfolio construction process or our systematic discretionary risk management overlay process, which again, we're quite proud of for the solutions that we continue to deliver to our clients. So we'll wrap it up there. Darius presenting our macro minute for Wednesday, October 23rd, 2024. Best of luck out there. We'll catch you back here tomorrow. Cheers.